Hello and welcome to Investor Roundtable at the ET Soonicorns Summit. I'm Miloni. With over 100 unicorns, India is now among the most attractive startup ecosystems of the world when it comes to private equity and venture capital investment. Many records were set and milestones were reached in 2021 for the Indian PEVC market, with over 2,000 deals closed compared to over 1,000 each in the last 2 years, as per data from the Indian Venture and Alternate Capital Association. Capital moved away from China to India. Average deal sizes grew, and there was a tremendous surge in valuations focused towards forward-looking tech businesses, and funds started taking ESG seriously. Come 2022, things have changed. High inflation, lackluster markets mean money is flowing with greater and increased checks and balances. What will be the impact of this on India's roaring startup ecosystem beyond the valuations and the blitzscaling? I have with me Shanti Mohan, founder and CEO of investment platform LetsVenture. She has recently launched a micro venture fund to invest in early stage startups. Good to have you here with us, Shanti.
Thank you. Thank you for having me.
We have Vaibhav Domkundwar, founder and CEO of Better Capital, an early stage venture fund that invests in category defining businesses. Vaibhav, welcome.
Thank you so much, Miloni.
Joining us also, Sanjay Mehta, founder and partner, 100X.VC, a first check fund that invests in very early startups with iSafe notes, which are India Safe notes, also short of simple agreement for future equity. And these are instruments that promise a stake in a startup at a future date. Sanjay, welcome.
Hey, thank you, Miloni. And hi, Vaibhav. Hi, Shanti.
All right, with that, let's begin. The year 2021 was a banner year, wasn't it, for the investments? You know, money was just there for the asking, but things are not the same now, as I mentioned a bit earlier. Caution has replaced the euphoria. Startup funding has begun to see a noticeable slowdown. If we take a 12 to 18-month view, what are the factors and trends that you see that could shape the ecosystem in India? Shanti, if we could have your view first.
Yeah, thanks for having me, Miloni. I think what we are seeing today, and I think what we have seen in probably earlier downturns, is that early stage investing typically stays insulated from market conditions, right? Because when you're investing in a very early stage company, which is probably the angel seed stage, you are actually looking at a 5 to 7 year investment horizon, right? So actually it's a great time for investors to start investing in early stage companies, because your deal access gets much better, right? And the deals are less competitive in terms of capital, because last year and this year, just to kind of give you the reference, last year at LetsVenture we did about 305 deals. This year till June we've already done about 210 deals. But I think the difference, what I see, is that last year the round sizes were much larger and the urgency to close deals was much higher, right, from the investor perspective. But this year, I think people are okay to take a little bit longer to close the transaction, which gives the investors a little bit more time to deliberate and to actually decide whether they want to invest. That's on the investor side. If you look at on the founder side, I believe, as a founder, you will start a company only if you really want to be a founder. And if you really are solving a very large problem, you really are interested in actually entering the entrepreneurship space, you really think that you have a good shot at building a good business, versus starting a company because capital was easily available, right? And this is kind of very consistent to what we have seen in earlier downturns. quality of founders become much better. Capital also gets better because a lot of investors who don't understand the asset class, who are kind of not understanding what this entire thing means in terms of just the journey they need to go through, also kind of goes away. Right. So I would, as a founder, I am kind of really optimistic that, this again gives us an opportunity to go back to fundamentals, go back to basics, ask the right questions for both the founders and the investors. So really, I think the next 12 to 24 months, we will see some very good companies emerging. We will see those access opportunities being given to angel investors. And of course, we will know this only after 3 to 4 years. But I actually think it's a great time for the ecosystem because it kind of takes away the non-fundamentals, brings us back to basics.
All right. It's almost like you welcome the hardships, Shanti. But, let's get a view from Vaibhav next. Vaibhav, what do you think?
Yeah, so, I completely agree with Shanti. I think she's covered it really well. Just to add to that, look, I think, I've been an operator for 20 years. I've seen about 3 downturns. Every time they are really, really bad when you're going through it. But as you go through multiple, one of them, you realize that that's part of the system. That's the part of the process. It's a cleansing process that happens to clean out noise and over exuberance and things like that, right? So to be honest, I think, we are probably overthinking the downturn in terms of the negativity, right? I think you want to be very cautious in terms of, hey, it's not 2021 at all anymore. But beyond that, I think we are going a little more negative across the board. Because look, the process of building has never changed, whether investors feel happy or fearful, right? The problems remain the same, the customers remain the same, the founders are building exactly the same way at the core, irrespective of whether the capital markets in the private markets are bullish or bearish, right? So I think it is very important to put that in perspective and make sure that we're continuing to build. Now, I've seen the 2 downturns in the US, the dot-com bust and the financial crisis. And this, I think, is probably India's first deep crisis that we're all going through. So it's actually a great learning experience for investors, for the ecosystem, for the founders, for people who are working at startups as well, because, that emotion of saying that, hey, I want to go build something at an early stage firm, even that's getting affected, right? So I think we want to play a balanced act here in terms of the fact that, across our companies, we take very early risk at a pre-product stage, at an idea stage. And none of that has changed at all. The only thing that has changed for us is how we think about building and how we think about capital and de-risking capital raising and things like that, right? So I think broadly, the only thing that we are asking our founders to factor in is how they use capital, how hard it is going to be to raise, and how they want to behave in that. So in the next 12 to 24 months, I think we're generally going to be slower, right? Like Shanti also mentioned, because look, I think the investor part is very simple, right? I think when the public markets are up, everybody thinks everything is up, right? If SaaS companies are trading at 100x, we were ready to pay any price. But now that they are down to 4x and 7x and 10x, you can't value early stage companies that way. So I think from a building perspective, which is where I think majority of my mind share is on, we don't want to be sort of influenced too much by the capital markets. We want to be cautious, but we don't want to be influenced too much. So I think the next 12 to 24 months, I think the real founders who are long-term builders, who are committed to building their own companies, will thrive and survive. And I think the downturn will teach, right? See, as investors, all of us are giving them guidance, but what they're learning from each other is going to be very important. So in my opinion, I think 2022 is going to be highly educating to our founders. And I'm seeing it, right? The way they're internalizing, whether the founder has 80 million in the bank or 800K in the bank, they're all going through this process, which is irreplaceable. So I think it's all good news, as long as you do not take the bad news, too lightly or too seriously.
All right. I think that's a good point made, Sanjay, if you could come in, I think that the one thing that Shanti and Vaibhav are possibly, while they say that, yes, everyone has to be cautious and stuff like that. Also not focusing, but maybe from my side, the point is that we will see a lot of businesses break down, right? We'll probably see mergers, we'll probably see acquisitions. We will see businesses that will go flat. So Sanjay, what is your take?
See, the growth in the past couple of years for most of the Series B onwards companies, right, so-called the big boys, was a function of capital raised, right? So more the capital raised, more the capital pumped in, more marketing being done, more growth being happening. So we were buying business, we were buying customers, we were buying, cost of customer acquisition was going through the roof, and which was unsustainable. And a lot of while entrepreneurs are at the forefront, but it was investors which were chasing those growth, right, and pushing entrepreneurs to get those numbers. Today, when things are getting stable, people are getting sane, as Shanti mentioned, saying that getting back to fundamental, and as Vaibhav mentioned, across going back to building the basics kind of stuff. So we are looking at now founders who are looking at retention more than acquisition. How do you ensure that lifetime value of the customer is increasing, the CAC is going down, the fight for talent is reduced. I wouldn't say over, but fight for talent has been reduced drastically. My cost of hiring is leveling across. So I think there are different parameters which are happening across. For investors, it's a double-edged sword. So all of us have got a good portfolio. Now suddenly those portfolios have rationalized, some discussions of exit of, suddenly is not happening or possibly stalled. I mean, everything happening on that positive side, which was in the bull run. Those markups suddenly have to revalue. All those things have started happening. On the other side, because it's not like we are tourists. We are there, like all of us have seen over a decade of investment and investment journey. We know that, let's invest in these times, build a portfolio which will be great to harvest in the good times. So it's a part and parcel for us. This is like, you have to balance along. That's what I would say across. In the good times, you keep selling, and these are the times where you keep buying.
All right. Okay. So, everyone's talking of a balancing. I want to go to something that Shanti said right at the beginning, that there might be funding driven towards the early stage startups. Shanti, that's what you mentioned, right? But
Yes.
which are the other stages and also the sectors that you see will see investments in this 18 to 24-month period? And, which are the ones that will struggle? So, Shanti, if you want to take that first.
Yeah. So I think in terms of just the new businesses, what we are seeing coming up on LetsVenture, as well as just in the ecosystem, I think there will be digitization of traditional businesses, right? And when I say that, it's more like, companies formed around supply chain, manufacturing, right? So some of the logistics, right? Some of that digitization of those traditional businesses and creating efficiency and then creating a new paradigm in terms of customer experience is what we are starting to see emerge, right? And it's a great time because I also think, Miloni, I mean, just taking a view, I think it's a great time to start something which is completely new in terms of customer experience, because nobody is in a hurry to build the next big unicorn in the space, right? So what this downturn does is that if you're able to get in the capital for that idea, you have enough time to go into the market, build your business, build your customer base, because capital is scarce, right? So that is the other way to look at it as a founder, right? So that is one kind of sector we are seeing happening. The second is, I think D2C products, right, is going to continue to see a lot more companies coming in that space. Because today, if you look at the market in the last 5 years, the Indian consumer has also become a lot more open to trying out new products, right? So we are, in fact, it is not like I'm very conservative and I'm trying out a new brand. or when I'm trying out a new product, because that category of buyers in that 20 to 30 are already exposed to a very different mechanism of marketing, right? And they are actually pretty open-minded when they are looking at new products coming into the market. I think loyalty towards existing products is a little lower, and we are happy to switch loyalties if we find something which really fits what I'm trying to do, right? So I think that is the second kind of very big change. The third, of course, the traditional industries like fintech, health tech, SaaS, all of this is going to continue to kind of grow, because those are the basic in terms of just business building, right? I think what will change is just the valuations at which they're going to get valued, right? So a SaaS company is not going to see a 12 to 15x multiple on ARR. They're going to see a different multiple start to emerge, right? So I think the price point or the entry point of these companies will change, and it will become a lot better. And I think a good price is good for the founder and for the investor, right? I think sometimes founders don't internalize this. Raising at a high valuation at a very bull market might be easier, but then you have to sustain it, right? You have to continue to give the multiple. And you have to, if you have raised at $1 billion, you have to exit at $4 to $5 billion, right? And then you need those market conditions, which has to be conducive to that in terms of just an exit opportunity. So I think that these business environments actually is very good for both the investor and for the founder, right?
Yeah.
And in terms of what are the trends we are going to start seeing in terms of growth and early stage.
Okay, all right. You want to go next, Vaibhav? Which stages of funding you think will get importance in this time, and the sectors? Shanti's already mentioned D2C, and of course, the ones that everyone loves, which is fintech.
Yeah. No, look, I think the way I look at it is there is a framework here that is driving the behavior on the investor side, right? And there is math to be looked at, right? So what happens is that, let's say a growth investor who was able to underwrite $1 billion, a $2 billion, a $5 billion sort of a milestone for a company, is now suddenly wondering if he or she can do that, right? Because there is a lot of capital that has been wiped out in the public markets, correct? Which means their ability, what they were thinking is going to happen. Coinbase was at $100 billion. Snowflake went public at $100 billion. I mean, I've built for a long time. In my early days, $150 million exit was supposed to be incredible, right? And now we're talking of tens of billions of dollars, right? Now, I think that math changed over the last several months, right? And when that math changes, the growth investors are suddenly not able to underwrite what they were able to underwrite earlier. And in fact, because they've suffered deep losses, they're actually going more negative and saying that, no, I was super wrong. Right? Now, if that changes, that goes to the BCD folks, right? And BCD suddenly gets affected, because if they are sort of saying that, hey, I'm just aiming for a 3x fund, their numbers of what valuations they're going to get to change dramatically as well, right? So I think growth and BCD got affected first, right? And then it is flowing downwards. Now, I think the math is very clear from B onwards, right? And now what happens from pre-seed to A is it is less about the math and more about the fear. And the fear is essentially that, hey, like, for example, I think we take pre-seed risk at scale, which means we are in a completely unknown territory when we are writing a check, correct? Now, what happens is that if the BCD folks have changed their math altogether, the A folks who are sort of saying that, hey, let me figure out what's interesting, right? Their math has changed as well, right? And not only has their math changed, they are slowing down because they don't know what's going to happen, right? So A is affected because of that. And pre-seed and seed also then, folks like us, we have to question what sectors will sustain what valuations and what sectors will sort of get to a very strong Series A, right? So there is a lot of confusion and fear, I think, from a pre-seed to Series A perspective. Now, we can always say that, look, I think I can always do a pre-seed and seed because I have to raise 2 years later and the market will turn and it's completely fine. But I think that's very zoomed out version of it, right? when you have to say that, hey, because, as a GP, each of us are underwriting something, we have to return capital, we have to be right enough number of times. I think that changes everything. So I think pre-seed, seed is getting affected. Everybody is going slower. And I think that fear right now is probably at the highest. And it's less of fear, right? Because people have enough dry powder. It's just that I think, you just don't know the roadmap, right? Because the math has changed on growth. And here, what you were counting on earlier, you were underwriting, X number of unicorns earlier in a certain period of time. Now you're saying, no, let me change my math to 500 million, 300 million, right? So I think there's a lot of math behind this as well, which is affecting a very framework-driven thinking as well, right? I mean, there's nothing right or wrong here. It's just about being realistic.
Vaibhav, but what are the sectors that you feel will struggle because of this?
So I think technically this applies to all sectors, to be honest, right? But the sectors which will suffer more is the ones who actually got a lot of money at the high valuations and whatnot, right? And historically, if you see, fintech and edtech in India has been funded the most. Right, so we've seen like our portfolio at Bear Capital also is super deep on fintech and edtech. Right now, not only are the valuations corrected, but we've all taken so many bets that even I want to see all of them play out before we say that, hey, we were right on this or wrong on that. Right. So in my opinion, I think fintech and edtech will move quite slow. I think SaaS remains fairly evergreen, right? As long as, from a framework perspective, you have a thesis of what is India to global SaaS looks like and what you're looking for. I think, software is reinvented every decade, right? So there's always enough to build. I think SaaS will remain interesting. What we're seeing is, I think climate is just starting to see some green shoots, right? We are very deeply committed from a couple of years, and we're starting to see better teams, and we're starting to see more conviction broadly in the climate sector. And I think it has been very interesting to see a lot more sort of Series A activity in the EV sector, right? Because I think for a long time, I think people were just trying to figure out and make their minds up, but we're starting to see that move as well. So I think climate in general, SaaS will continue. And then I think agri, health, agri may be capped at, how much you can do and how many white spaces are there. But I think health, I believe we are starting to now see fresh companies taking a new view, creating new models. So I won't be surprised if health becomes sort of a very interesting sector over the next 24 months.
Thanks for that very detailed response. What's your take on it, Sanjay?
So 2 weeks back, we published 100X sentiment outlook survey. And let me just share one of the questions where we had asked investors about their priority interests in the sectors. And the top 3 sectors which emerged were SaaS, deep tech, and fintech. So I think fintech will continue a lot of interest. While EV and Web3 were not there as a part of the whole survey, this is my personal choices. I believe EV and Web3 sectors will break out, and we will see a lot of opportunities coming in EV and Web3 space. So I'm very bullish on that side. From the negative side, as what Vaibhav mentioned across EdTech, is something, overly played out kind of stuff as a sector. So I see challenges. Travel tech will not come back. We lost that momentum after COVID in the travel side of it. So I think still that side of it is still not recovered as such. Agri, while yes, there will be some offshoots, as Vaibhav mentioned, but not as an overall sector, not as much opportunities which we will see across. On the media side, I find very interesting plays which are coming across. Very nascent, but I believe media, a lot of good innovations which I'm seeing across, happening across. So media and content is ripe in that sense. I would say across. So these are a couple of spaces which I believe on a personal space. But as per the survey, top three were, as I mentioned, SaaS, deep tech, and fintech.
All right. Okay. All right, Sanjay. That's a good indication, and it's given me a great insight into what you individually or so. Shanti, I want to move to you next. You recently announced the launch of your new VC fund, Propel, to invest in early stage startups across e-commerce, fintech, SaaS, right? Uh, you also built one of the biggest angel investing platforms. So when it comes to angel investing, what are the trends that you are seeing, which you think could be indicative of the future of private investing in India?
Thank you for that. So the Propel micro fund is more like just a small micro fund, and I have been investing informally for the last 7-8 years through LetsVenture platform, but I was not actively kind of doing it. I was, because running LetsVenture is a full day job for me, and meeting a lot of founders, but never consciously went and created a thesis. And I thought now it was a good time to go create a thesis and actually work with few founders, because that lies at the core of how we think at LetsVenture, right? That we have built a platform for founders while we are making it easy for investors to discover the good founders, right? So really along that thesis. And through Propel, we have done about 16 transactions. Again, I would have loved to do more, but the intent was to work with a small group of founders. But if you look at the trends on angel investing, and it's been very, very interesting in what we are seeing on the platform. Today, just to give you some stats, LetsVenture has close to about 13,000 investors on the platform from 60 countries, right? We have close to about 3,000 investors on our angel AIF, right? So really a large liquidity pool there. But I think the trends, what we are seeing is, there are a lot more CXOs and mid-level managers of companies now starting to actively enter angel investing space, right? And really aligns to our vision of saying that we want to make private market investing go more mainstream. We want to see angel investing go more mainstream in India, right? We are also seeing another very interesting trend where angel investors are also getting younger, right? Because if you look at the ESOP and the buyback in the startup ecosystem, which has happened, in the last 2 years, a lot of liquidity has been created, right? And a lot of people of the ecosystem have now gone into private market investing, where their asset allocation percentage is way higher than what a traditional investor would look at, right? So those people, like, again, much younger investors and actually older experienced founders. So that dynamic is playing out very interesting, right? But their asset allocation is close to 50 to 60% to 70% towards startups, right? Because that is what they understand as an asset class, right? So that is the very next interesting trend we have seen. Third is, of course, the decision-making time is getting a little longer, right? So though people are committing, because of the downturn, they're taking a little bit more time to decide where they want to invest in, which is actually very healthy, right? Because in my view, this is a long-term view you need to take as an investor. And we are very pragmatic about this asset class, right? There is no need to go rushing and start investing, because when you create a portfolio as an investor, you need to give diversity of time into your portfolio. And when I say that, imagine if last year I had like a 20 lakh corpus and I invested everything last year, I would not have been able to take advantage of the value benefit which is coming out of a downturn, and actually would have invested in some good founders this year, right? So really you need to take that time diversification into your outlook into angel investing. And that we are starting to see that happen, where people say, okay, I want to allocate capital, but I want to go across time. And I think the fourth most important thing, which I have to mention here, because I have been traveling outside India, went to the US for 6 weeks. I think India is becoming real for investors globally, right? People are getting FOMO of missing out in the India market. So now it's like, I need to start engaging more actively. And that I thought was the most interesting shift in my mind. It's not about going and convincing people that you need to look at geo diversification. People are saying India has to be on my roadmap in terms of angel investing. which is very good because I think some of our founders will really benefit from global capital. And this has been happening, right? Like Vaibhav and Sanjay, and I think we all have been working with global investors. But that story also going mainstream outside India, I think I'm really excited about that, right? And we are kind of sitting at the cusp of an ecosystem which is going to kind of become the largest ecosystem in this decade, right? So I think opportune time for also investors globally starting to look at India markets.
Yeah, we were just speaking with Sanjay Mehta yesterday of Bloom Ventures, right? And he said that, you know, earlier we had to have 4 slides on why you should invest in the India market. And he's like, oh, no slides needed now, you know.
Absolutely.
They know
absolutely.
everything that they need to know.
Absolutely, Kanika. And I think just one more point is that people are also now, because they have looked at private equity and because there's so much talk about startup, I think investors are also now becoming a little bit more open to alternate investing opportunities, right? Besides equity, right? Can I do debt? Can I do NCDs? Can I participate in a different form into the startup ecosystem? And equity does not seem to be the only route to getting that exposure. So that is the other kind of trend we're starting to see emerge.
Okay. One question offshoot of all of this, Shanti, is can you give us a sense of, you know, what is the participation of women on the platform when it comes to investing?
It's a great question, and I love that question. You know, last year when we looked at my platform numbers, and it's so interesting, we had 10,000 investors and we had exactly 25 women on the platform, right? And I was like, this just does not seem right, right? So we said, let's go do something about it instead of kind of constantly looking at data. So we then launched a women in investing network. And we said, let's make it easy for people to get into that asset class. So we started running this 4-week cohort courses for women. And of course, we had about 120 women go through that program. But out of that, 250 women are today on my platform, right? So a lot of people didn't want to go through the program. They just directly came onto the platform to become investors. 50% of them have already written their first check, right? And if you look at the profile of the women investors, you know, they are like CXOs in large organizations, CFOs in a global firm. So it is not like they have any less credibility than their male counterpart. I think it is just that, you know, when you shine the light on a topic and you start to give it attention, it nurtures and it grows with all the love you give it, right? It is absolutely that, right? So we are really, I'm really happy we kind of thought about it. And you know, make it easy for women to start investing. So we introduced something where we said, okay, if you're a woman investor, you can start with a smaller check size, right? Because somewhere there had to be a little bit of support given. And you know, we also reduce our check size, like we bought in this cohort based group learning, and there are so many good questions, so much learning happening in those cohort based learning, right? So we hope to make that number like, you know, 2000 by the end of another 2 years. But I think it's very much possible, Miloni. It is just that I think women are not giving it priority. And I think if we are able to message it to them and then give attention, I think we'll be able to get a lot more people starting to participate.
Yeah, I think they just need a signal. And I think so the signaling perhaps.
Absolutely.
Perhaps
Absolutely. Yes.
Okay. Wherever I want to come to you next, you know, you're a solo operator and Better Capital mostly invest in pre-seed, pre-product startups. Any sectors you feel are being overlooked by investors, which you think could be vital, you know, in terms of sustainability and in terms of growth of the bottom 500 million? I know you mentioned climate, but anything else that you're seeing?
So I think there is a horizontal answer to it and a vertical answer, right? So I think the reason we started Better Capital with a focus on pre-seed only was also because, you know, my expertise over 20 years is sort of doing 0 to 1 and 1 to 10 sort of journeys, and very focused on sort of thinking about product first and distribution first stuff, right? So you can take a look at any problem. There are multiple ways to build a solution. I come from the school of thought, as well as my experience has been sort of saying that, hey, how do you think of scale at the same time as you think of the product, right? And I think that's where we found the biggest white space in India. Not that people were not investing in it, not that people are not building, but I think it was not being stressed on enough, not enough was being done. And that's the white space I think we decided to build on, right? And since we were very focused on saying that, hey, we have conviction of saying that we want to build sort of a free first product that is distribution focused. So let's say a Philo, a Teachment, a Kata book, so many of them that we've done over the years, that became sort of our core sort of horizontal thesis that, hey, this is what we want to build. And I think it was also driven by sort of what we saw in India post-Geo, where sort of users' data and their engagement on apps and everything changed completely. Right? So I think all of that played into sort of the setting up of Better Capital with a view that I wanted to underwrite myself, right? So what I'm saying is, we did many sectors early, right? As in subsectors, neobanks and SME digitization and things like that. Going forward, similarly, I think for us, what is important is sort of building out Web3 infra. So sort of, I am personally, philosophically very committed to the inevitability of decentralization. Now, how it happens, when it happens, what tech works, what tech doesn't work, is sort of something that we'll see, right? I don't think I'm going to have an intellectual argument about that a lot of people engage in. I think I'm just committed to the fact that, decentralization is inevitable. And I think we're building sort of infra pieces largely, right? We've done some consumer facing stuff as well, but I think majority of Web3 that we will do will be very infrastructure focused. Second sector is sort of climate, what we call as better tomorrow. A better tomorrow is really about saying that, hey, what sort of a world do we want to leave for our children and their children, right? And I think, we've talked about it for a long time, but I think if you just look at what John Doerr has written, I think this is the decade. If we don't do it this decade, I think it's going to be really hard, right? And we're seeing some good founders as well. So I think sustainability and climate, I think we'll be very tech-driven and product-driven, as in, sort of solving again with scale-first approach.
All right. Okay, that's good to know, and we wish you success with it. Sanjay, to you now, while the world has been talking about slowdown in startup funding, 100X.VC wanted to double its ticket size for investments. So can you share your thesis for evaluating startups and, your growing portfolio in any particular sector that you are looking at?
So we are, Miloni, we are sector agnostic as a fund. So, but we invest only in Indian startups. So we don't invest in any company domiciled outside of India. So that's one as a restriction thesis. But we now invest 1.25 crore as a standard check, fixed check as a first check into every company which we invest. And we are looking forward to fund 100 companies, hopefully, and close it kind of stuff. So that's the pace at which we are going forward, doing the first check, investing in the startups. So sector-wise, as I mentioned from the survey, these are what other investors are looking at. For us, we are sector agnostic. We invest in every possible. The thesis for us to select or evaluate any startup first goes across the founder's right to win, in terms of their background and how the founders know the subject or what are they attempting across. Secondly, we look into their business model. What's the kind of way to make money, kind of profits, and what is the business model. Thirdly, we look at their unfair advantage, right, in terms of what's their IP, what's their strong moat. Then we look at the market opportunity, how large the market is, like it has to be sizable enough for us to look at it. And then we have an internal conviction where we look at least 20x kind of return minimum for us. That's our internal note, what we work across. Do we see an exit of at least 20x kind of exit? So the broad parameters would be this. Rest, it's all deal to deal, which we go through kind of stuff. And we have a good automated process in terms of inviting for applications to curating it within the team and closing it. That's why we worked on this iSafe notes, right? Typical any deals, if you look into India, when I was an individual investor, takes around 3 to 4 months to close a deal, right? Yeah, after term sheet, right? For the shareholder agreement. So this iSafe notes, it's like couple of days and you are done kind of stuff. So founders get quick money on their bank and they can start rolling out. That's why iSafe as a standardization helps us, scale our investing efforts largely. So that's where iSafes come at play. Just to touch upon, if you allow me, on the woman founder, right, which you
Yeah.
asked, Shanti. So I've been a very big proponent of educating and creating lead investors and trying to bring in more and more angel investors. Possibly, I would have trained or done session with over 5,000 plus investors, giving them insights on how to do angel investing. I ran a specific cohort for Fiki Flow. This is a female leader organizations by Fiki, and it was very interesting to see across how women were looking at angel investing, and most of them were trying to see across how they can deploy family money. Investing into startup as an asset class was more like an hobby. Uh, you know, uh, Keeping themselves busy. It was not coming out as a professional investor. How typically we would look into it. Their ability to evaluate deals, right? While their inner passion to put in money, I could inherently see, but their ability to evaluate deals needs to be, sharpened in every aspect, right? How do you engage across, know the various businesses? Like, for example, as an investor, you have to go through multiple businesses to being able to even evaluate, like look at what is coming up the future. So I think a lot of dedication would be required from the women's side in terms of bringing themselves up, in terms of their understanding of various businesses and the tech, because startups, I would say, across at least 70 to 80% would be tech or tech enabled, businesses. So a lot of work would be needed to done across if women investors, opportunities have to brought to them to invest, right? So in that sense, but on the other side of it, women founders, I find quite a lot, right? Entrepreneurs, women entrepreneurs. I would say every second investment which I would have done across at 100X, which we would see at least one woman founder or a solo woman founder or two women building business. So in that sense, from an entrepreneur side, I'm seeing great amount of energy, traction. A lot of women are coming and becoming entrepreneurs, but a lot of work to be done on the investor side. Shanti, I'm sure, is doing a lot of work on that, but still, I would say a lot more is required to bring women investors on board.
Yeah, there are some things that you said, when it comes to women founders also, they find it difficult to access capital. When it comes to women VCs as well, it's not like the pipe is really wide, right? Even there, we are struggling to see any sort of gender balance. So there is a problem on both sides. The VC ecosystem is male dominated, and women VCs may have their own unique challenges, So if you want to chime in there, Shanti, how do you bridge this gender gap in funding? And to some of the points that Sanjay brought out about how for women investing is possibly not a serious endeavor.
I would like to disagree there, right? Because again, from the cohort and from the women investors on my platform, I see very good profile of investors from the women side also, right? Like I said, they are CXOs of large organizations, they are CFOs, right? I think somewhere this asset class messaging has got missed out because it almost looks like a financial space, right? And that's where we're trying to change, and we're trying to bring those cohorts together, right? So I think that there are a lot of good women, like there is a woman who's a full-time trader as part of my cohort, right? There are people, she's a CFO of a large multinational, she's part of my cohort, right? So I would say that while I agree with Sanjay that there are a large element of women who are actually not able to understand or evaluate tech, right? Because of which maybe they may not be able to take a good decision. But I think it's about actually simplifying it and creating a process or a framework for them to be able to make a good decision when they are starting to invest, right? And like I said earlier, that's why we said, okay, go in with a smaller check size. So you start to experience the startup investing process before you start allocating a lot of capital there, right? So that is one part of it. But I think on the woman founder side and woman lack of VC, I think it's a global problem, Miloni. It's not just an India problem. We are seeing this everywhere, right? There are very few women partners in VC firms. There are very few women actively investing in private markets, right? So I think it's a global problem, and I'm sure it will change as we will see more women founders build successful businesses, and then they will transition into the investment space. I think that we will start to see to change, right? The third point on women founders, and because you have more women investors, should they invest into women founders? My answer is no. You have to think like an investment opportunity, right? If the woman founder is a founder who is able to compete in the business space, and she is a good business investment proposition, go ahead and invest into her, right? Because I believe that at the end of the day, the customer is not going to think if you're a woman founder or a male founder. The customer wants a good product he loves, right? And you have to compete mainstream in the market. For me, I have always told all my women investors, don't start this narrative of, oh, we will now start going and investing into women founders. I am not here about patronizing the community at all. I want you to make your best investment decisions when you invest, because I want you to make wealth out of your angel investing process, right? I want value and wealth creation on both sides. And again, like, it might sound very contrarian, but I'm not a a proponent of gender investing at all, because I just think it does not help anybody, right? While of course we need to create better processes of access to capital, because a lot of women are not able to even access that capital. I will create that access to capital. I will create knowledge for you to access capital, but your final allotment of capital has to be based on your business credentials and your ability to go build a very large business. And honestly, today I'm seeing women founders are amazingly ambitious, right? They are not apologetic about being ambitious about what they're trying to build, right? As well as, they don't want that extra marks for being a woman. I would like to say, right? And I think you're seeing very good founders, like what Vaibhav said, like what Sanjay said. I think both of them are also not going to invest if they are not confident that the team will actually be able to build a good business going forward. So, these conversations are good, right. Great, because it encourages women to kind of come out and actually say that the opportunities are wide open today. In a digital world, there are no excuses of access to capital anymore, right? And I think we have to just get out there. But I think it is great that we are having those conversations. People are a little more conscious. They're actually willing to be a little bit more patient when they're kind of listening to your plan, help you a little bit more. But it is not an excuse for someone to not build a good company.
Yeah. And Miloni, I think, like Shanti mentioned, I couldn't agree more. And I think, see, what is important is really, it's all about removing bias, right? And so many times, I think we talk more and act less. And I think it's all about acting, right? So we all know what the issue is, right? I have a daughter, and I know that I don't want her to grow up in a world that does something for her because she is a woman. I want her to win because she is really good, right?
But also you don't want a world where they're going to discriminate against her because she's a woman, right? Like
I was just coming to that, right? So that is where the action part comes and removing bias, right? So for the longest time, we had a very high percentage of women founders, all women teams, husband-wife teams. I think I might still have more husband-wife teams as a percentage of the portfolio. And these are serious biases in our ecosystem, serious, and not just Indian, right? Global. So I think, the best that all of us can do is really remove the bias by acting, because I think we've talked enough.
Okay, on that note, I want to touch upon corporate governance and sustainable growth being profitable. You know, there is a lot of focus on it and talk about all of these things that this has to be made part of the plan from day one for startups, because there have been so many controversies with startups that have highlighted the toxic work environment, the lack of accountability, the lack of responsibility, and so on. It's put into sharp focus the question whether founders have even a basic understanding of corporate governance, and what do you think can be done to foster the right values in this ecosystem? And as VCs who are here to make a profit on your investment, how do you see your role? What are the challenges that you face with founders on issues like these? So Shanti, if you want to start, and then we just go around the table.
Yes, absolutely. So I think it is surprising that we're even talking of governance, because that should be the starting point of building a company. Yeah. So actually, a lot of times angel investors and founders both say, let's cut through the diligence process because we want the money to get into the bank quickly. There is an urgency. My money is running out. I don't have this time for financial and legal due diligence, right? And I think that is something we have to change both from an investor perspective and a founder perspective, that I need to ensure that I cannot cut short the process of diligence when I'm actually investing into a company. That is one. And second is just board governance. I think as a board member, you have to ensure that there is some framework of governance which is set up in the company. And I think these are very simple aspects. These are very simple aspects of just ensuring that basic hygiene is maintained in terms of the way the company is governed. And I know, as a startup, you may not have a lot of money to bring in a full-time CFO. I think there are good lean ways to manage that problem, to actually ensure that, you look at open source solutions in terms of what a good governance policy is. And we at LetsVenture have actually open sourced a lot of this information, where you just need to ensure that you have a good founders agreement. You need to have a good agreement for your advisory engagement, right? And just good processes on due diligence, which is done, good financial practices. I think these are very basic, again, not very complex. If you're able to put that system in place, as well as I think what I'm also seeing in younger startups, founders are actually pretty good when it comes to HR, just to give credit to even our younger founders. I see that a lot of conversation in WhatsApp groups saying, I want to know what's the best HR practice you're following. Can we please share among each other? Or, how do I go communicate back to my employees that they need to come back to work after the work from home? What is the best way to message it to my employees so that I don't create a environment where I'm actually sounding very ruthless, right? So not to say that actually founders don't want to appear like they are employee friendly. I think most of them, the intent is I want to build a good culture. I want to build a good institution. I want good employees, because people understand that hiring is one part, but retaining good talent is a very different game, right? So you don't want to go down the wrong path. But, we are all learning, Miloni, honestly, right? And I think we're just becoming aware that you cannot cut short the process of diligence and governance when you're building a company. There is no hurry to get to any state of business by, short circuiting all of these, because it is going to come back to you. We are living in a country which is highly regulated. We all understand one wrong step and you've moved back at least 3 years.
Sanjay, you want to go next?
Yeah, so, these are early stage companies, right? And these are first time founders, do not have any understanding. So a lot of the mentoring is required across from investor side, while we definitely pass on the information, the mentoring and the coaching. But it's very difficult to manage, the portfolio and what's happening on a day-to-day basis. We are not running the business, right? And it typically boils down to investing in right founders, right? And founders with integrity. There are going to be challenges all along while they are building company. There are going to be, and this is not an India only problem. It's across the world, right? So every startup goes through that journey. And founders with right set of values have been able to see their success much better than the founders who don't have those right values. And once you start as an investor doubting and your reputation is at stake, then challenges start building across for your fundraise in every aspect, right? So people understand their reputation plays a big role in that sense. But these are young companies, so I would always give them discounts and try to work with them. I would try to give them all the benefits of doubt. I'll try to steer them to a direction where they get mature with every step, every fundraise, every board meeting, what they have across. So I think formation of the right board members, following the right principles would make sense. So, in my pitch, I've got one slide which I always keep across for all the startup founders. It's saying that, while you do every disruption and innovation, do not innovate in legal and finance, right? So follow the law of the land.
Good slide to have, yeah.
Right. So idea is, no window dressing, nothing kind of. I mean, but these are young founders. Please understand, we'll have to train them, coach them. We can't be a police, right? Investors are not, and these are not criminals. These are young kids which we are working across building companies. Need to help them hold their hands. I would put it in that way. I mean, look at our corporate governance in our listed companies. I mean, tell me a name which is not there, where SEBI would not have put down fines of, I mean, we have seen every big names, right, be there. So, we need to find a way to ensure that the right governance and information about governance and the value of governance is played out well to the founders. These are coachable founders. These are founders who want to learn, grow, scale. So once they understand the value, I'm sure the entrepreneurs would play out in right way. For me personally, because I'm an early stage first check, I don't see any founders which are rogue. So for me, I mean, I've been fortunate in that sense.
Okay, all right. Vaibhav, you get to have the last word.
So look, I think I agree with Shanti and Sanjay both. Sanjay makes a very good point that I don't think the young founders are intentional in their acts that are not completely correct or something like that, right? But look, I've been sort of in this space for 20 years and in US, in India, and it is very clear that there is a governance problem, right? So I think we all must agree that there is a governance problem, and there are different types of people, just like we see different behaviors and different value systems playing out in any other industry, any other segment. You see the same playing out in the startup world as well. Let's say going back to school as well, you always had those kids who were cheating in class. This is no different, right? So I think it goes back to the value systems. I have come to believe that I mean, look, I can't change how somebody else is going to behave, because that behavior is an outcome of how they've lived life and what they believe in, right? What I can do is I can choose, founders and teams and people I work with whose value systems are aligned, right? Because see, governance is a very heavy word. It all comes down to knowing the difference between right and wrong, right? And I think that's where the problem is, right? So I think considering the fact that we are investing on behalf of our LPs, it is our responsibility to sort of do our part and, choose people whose value systems we align with very clearly. And I think broadly as an ecosystem, tomorrow, if we have more incidences of lack of governance or issues that happen again and again and again, then I think it's going to be a big negative, right? Because at scale, then people are going to wonder, right, if I can trust anything. There are situations where people know that they can't trust certain numbers or certain companies, correct? And that is all a reality. Okay? We just want to make sure that as an ecosystem, we continue to, like Sanjay mentioned, educate and mentor in such a way that, you know, those unfortunate bad incidences are lesser and not more. Because if they become more than a certain threshold, it's going to be bad for all of us, because it just takes trust out of the ecosystem, right? So I think for me, it is all about value systems. And I think it's very simple, right and wrong, right? Because like Sanjay mentioned, you're not running the company. You know, even if you're on the board, how much forensic analysis are you going to do? You can't, right? So I think it's a very people-driven equation, I think, right? And I think it's something that at least over the last couple of years, because we've had some unfortunate situations in our ecosystem as well, where I think all of us, we've talked to so many of my friends in the ecosystem as well, we've all just saying that, hey, you know, what do we do, right? And then, you know, just a more higher level view is we think there is something called karma, right? And I was just reading Jason Lemkin of SaaStr today. He said, there is no, I've been around the block for a long time, and there is no such thing as karma in the startup ecosystem. I don't know if he was referring to the new, you know, funding for WeWork founder or whatnot. But to each his own, to each his own.
Right.
Today, I think we choose how we want to live.
All right, you know, and on that note, thank you all so very much for a very, very interesting conversation today here at ET Soonicorns. And we're so glad that, you know, you could all join us today. Thank you for your time and for your thoughts. Shanti Mohan, founder, CEO, LetsVenture. Vaibhav Domkundwar, founder and CEO, Better Capital. Sanjay Mehta, founder and partner, 100X.VC. Thanks once again.
Thank you so much.
Thanks so much, Miloni. Thanks, Shanti, Sanjay.
Bye.
Bye. Bye.